This video is on expenditure method of calculating the aggregate annual value of goods and services. Remember, aggregate means total, annual refers to a year, and value is in terms of money. Expenditure is the spending that happens on the goods and services. The revenue that the firms get is the main player through which we calculate the gross domestic product through expenditure method. In this method, we add the final expenditures to get the value of gross domestic product. Following are the different kinds of final expenditures. Consumption expenditure. It is the expenditure that the households make in order to get the goods and services of firm I. Investment expenditure. It is the expenditure of other XYZ firms which purchase capital goods from firm I. GI is the expenditure that government makes to get the final goods and services of firm I. Lastly, the export revenues of the firm I. It is the expenditure on the goods and services of the firm I by other firms located in foreign. Sum total of the revenues that the firm I earns can be represented as follows. Revenue of firm I is identical to the sum total of revenues earned in the form of consumption, investment, government expenditure, and export revenue. RVI is identical to CI plus II plus GI plus XI. RV is revenue earned. CI stands for consumption expenditure. II stands for investment expenditure. GI stands for government expenditure. X stands for export revenues. Here, the equation is specifically representing the revenues earned by firm I. But what we actually need is the revenue earned by all the firms. Sum total of revenues earned by all the firms is represented through this equation. In order to get the gross domestic product, we need sum total of revenues earned by all the firms. But one thing that we have to pay attention is that all the expenditure is not made on the products and services that is produced only within our country. Certain things that we consume are bought from other countries. The firms might sell few imported goods and services as well. Since it is not produced within the boundaries of our country, the expenses of the imported goods and services has to be subtracted from the expenditures. Let C be the aggregate final consumption expenditure of the entire country. What we need is gross domestic product, that is the value of product that is produced within the country. Hence, whatever is related to the foreign, it has to be eliminated. A part of C is spent on imports of consumption goods. Hence, aggregate final consumption expenditure is equal to the total sum of all the consumption expenditure on domestic firms plus consumption expenditure on imported goods and services. Thus, C minus CM stands for whatever consumption expenditure that has been done by the households on the domestic firms. We have to do the same in case of investment expenditure and government expenditure. When we do that, we get the final investment expenditure and government expenditure on the domestic firms. This could be represented as follows. Second equation depicts the sum total of final expenditures received by the firms. The third equation is eliminating the value of imports. Because of doing this, we will be left with expenditure made on locally produced products and services. In the fourth line, the equation is rearranged and simplified. The final equation is as follows. Summation of revenues of all the firms is identical to C plus I plus G plus X minus M. X stands for aggregate export revenues and M stands for imports. Gross domestic product is identical to the summation of revenues of n number of firms. GDP is the sum total of all the final expenditure received by the firms in the economy.